If you own gold and silver, this Fed official just did something unseen in 14 years. Silver just watched something happen inside the Federal Reserve that hasn't happened in over a decade, and almost nobody outside of Wall Street trading desks noticed it. It wasn't a rate cut. It wasn't a rate hike. It was something quieter, and honestly, something far more unsettling. On June 17, 2026, the newest chairman of the Federal Reserve, Kevin Warsh, stood in front of the world's financial press and released a policy statement so short, so stripped down, that analysts scrambled to find a comparison point. CNBC ran the numbers. The statement released that day contained around 130 words, down from figures above 300 recorded in recent meetings. No forward guidance, no hints, no roadmap. If you own gold or silver, or if you're thinking about buying either one right now, this is the video you need to sit through completely. Because what Warsh just did to the way the Fed communicates with markets might end up mattering more than any single rate decision this year. Quick question before we go further. If you had $10,000 sitting in cash right now, would you put it into silver, gold, or would you just wait this out? Drop your answer in the comments. I read every single one. By the end of this video, you're going to understand exactly why traders are calling this a regime change at the Fed, why silver's reaction to Fed communication is about to become far more unpredictable, and why the thing Warsh removed from the Fed's statement might be the most important part of the entire story. Let's start at the beginning. Act 1. The man who wanted to change everything. Kevin Warsh isn't new to the Federal Reserve. He served as a Fed governor years ago, sat through the 2008 financial crisis from inside the building, and left with a reputation as one of the most vocal internal critics of how the Fed talks to the public. He got his chance to lead the institution in 2026, taking over from Jerome Powell. And from the moment he walked into that first press conference, it was clear he wasn't planning to run things the old way. Here's where it gets strange. Wednesday's release contained no information on how members voted, previously a fixture at the end of releases under former Chairman Jerome Powell. Instead, the statement only confirmed a unanimous vote. No dissents disclosed. No visibility into who wanted what. Think about that for a second. For years, investors used the voting breakdown as a signal. A close vote told you the committee was divided, which told you policy could shift quickly. A unanimous vote told you the Fed was locked in. Now, that signal is just gone. Warsh has specifically criticized how the Fed communicates, arguing that it leads to policy errors and entangles the central bank in markets. He believes the Fed talking too much about its future plans actually makes markets less efficient, not more. In his own words at the press conference, he described this as part of a broader effort to rethink Fed practices and give the American people concrete new direction on price stability. But here's the part that should catch your attention if you're holding metal right now. Act 2. Why silence is more dangerous than noise. Most investors assume less Fed communication means less volatility. Fewer words, fewer surprises, right? Wrong. It's actually the opposite. When a central bank stops giving forward guidance, markets don't calm down. They start guessing. And when big institutional money starts guessing instead of reading a script, positioning becomes far more reactive to each individual data point. Every jobs report, every inflation print, every headline out of Sintra or Washington suddenly carries more weight than it used to because there's no Fed roadmap softening the blow. Pause for a second and think about what that means for a market like silver, a market that's already thin, already sensitive to sudden shifts in real yields and dollar strength. Less predictability from the Fed doesn't mean less movement in silver. It means sharper, faster, less telegraphed movement. And here's where the story deepens even further. At the ECB's Sintra Forum on July 1st, 2026, just 2 weeks after his first meeting, Warsh took the stage again. This time, he doubled down, telling the audience plainly that if anyone in households, businesses, or financial markets believed this Fed would tolerate inflation above 2%, they would be disappointed. He also confirmed that inflation risks have come down in recent weeks, pointing to falling energy prices following the Memorandum of Understanding between the US and Iran. But he stopped well short of declaring victory. Most people stop their research right here. They hear, inflation is easing, and assume rate cuts are coming. Gold and silver get a tailwind. End of story. But that's not what the data inside the room is showing. Act 3. The hawkish surprise nobody priced in. At that very first meeting in June, while the Fed held rates steady, 9 of Warsh's 18 colleagues on the rate-setting committee signaled support for higher rates before year-end, with 6 of those backing 2 separate quarter-point hikes. That's a dramatic swing. Just 3 months earlier in March, Not a single policymaker had penciled in a hike at all, and the committee as a whole was forecasting a cut for 2026. Would you have expected that? A brand new Fed chair, widely seen as aligned with a White House pushing hard for lower rates, walks in and oversees a committee that suddenly tilts hawkish? Markets reacted immediately. Stock prices fell sharply after the statement dropped, and bond yields moved higher. The 2-year Treasury yield spiked to levels tied directly to that meeting, and it's held near 4.2% since. Here's why this matters for silver specifically. Silver doesn't just trade on inflation fear. It trades on the relationship between inflation expectations and real interest rates. When yields rise faster than inflation expectations, real yields climb, and that's historically been a headwind for precious metals. But when a hawkish Fed is also an unpredictable Fed, the usual playbook stops working cleanly. If this trend continues, a Fed that talks less, moves more unpredictably, and refuses to commit to a rate path, silver may start behaving less like a slow, macro-driven asset and more like a market pricing in surprise risk on every single data release. But before we go further, there's something almost nobody in the mainstream financial press is connecting to this story. Warsh didn't just change the statement. He also announced 5 internal task forces, one focused specifically on rethinking how the Fed measures and frames inflation itself. That means the very definition of what counts as price stability could shift under his leadership, not just the policy response to it. If you're enjoying this breakdown so far, hit the like button. It genuinely helps more people discover this kind of deep macro analysis, instead of the surface-level headlines everyone else is repeating. Act 4. The AI Wildcard. Here's another layer most silver investors are completely missing. Warsh flagged the AI industry directly as something the Fed is now monitoring closely, noting that as major cloud computing companies rush to build data centers, the price of computer equipment and memory has been climbing sharply, and consumer electronics makers have already raised prices in response. At the same time, Warsh noted that structural productivity in the US has been running in the high 2% range over the past 4 quarters, and he expressed cautious optimism that AI-driven productivity gains could eventually help ease inflation from the supply side. So picture the tension here. On one hand, AI infrastructure spending is pushing up prices on hardware, memory, and electronics, inflationary. On the other hand, if AI eventually boosts productivity enough, it could pull inflation down over a longer horizon, disinflationary. Warsh is sitting in the middle of that contradiction, trying to set policy in real time, with a Fed that's talking less than it ever has. Most retail investors watch headlines. Professionals watch positioning. And right now, professional positioning is telling a story of hedging against surprise, not against a clean, predictable inflation glide path. Act 5. What this means if you're holding silver. Let's bring this back to the metal in your hand, or the metal you're thinking about buying. Historically, silver has performed best in one of 2 environments. Either real yields are falling and the dollar is weakening, or fear and uncertainty are rising fast enough that investors want a hard asset, regardless of what yields are doing. What's forming right now doesn't cleanly fit either box. You have a hawkish tilt at the Fed, which normally pressures metals. But you also have a central bank that has deliberately removed its own forward guidance, which historically increases uncertainty premiums across every asset class, including precious metals. The probability begins increasing that silver's next major move, whichever direction it goes, happens faster and with less warning than the moves you've seen over the last few years. If you're someone who wants to understand what's actually happening underneath the headlines, instead of chasing every red or green candle, consider subscribing. This channel is built specifically for investors who want to think one step ahead of the crowd. Final act. So this isn't simply a story about a shorter Fed statement. This isn't just another press conference that came and went. This is a Federal Reserve chairman deliberately dismantling decades of central bank communication norms at the exact moment inflation, AI-driven cost pressures, and geopolitical energy risk are all colliding at once. Fed watchers have already started calling this the beginning of a genuine regime change at the central bank. And regime changes historically are exactly the moments when gold and silver stop moving quietly and start moving with force. So here's the real question. Is this just a new chairman putting his personal stamp on how the Fed talks to the public? Or is this the early signal of a Fed that's preparing markets for a level of volatility we haven't priced in yet? What happens at the next FOMC meeting on July 28th and 29th could tell us a lot more than the meeting we just walked through. If you made it this far, you're already doing more homework than most people holding metal right now. I'd genuinely love to hear what you think. Is Warsh's silence a warning sign? Or is it nothing more than a communication style change? Comment below. And if you want more breakdowns like this, the ones that connect Fed policy, real yields, and precious metals in a way that actually makes sense, subscribe and turn on notifications, because the next few weeks at the Federal Reserve might end up being some of the most important of the entire year.